Nifty opens below the 18,000 mark as a hawkish Fed raises rates with no sign of a pivot anytime soon. Stocks, however, recover and Nifty reclaims the 18,000 mark. PSU banks continue to rally while IT and pharma lag. Mid-caps are relative outperformers.
Mahindra & Mahindra Finance surges after reporting its best asset quality numbers in 3 years. Dispersals at 16-quarter highs, while the management tells CNBC-TV18 they expect to maintain double-digit growth going ahead.
Voltas posts a weak quarter, reports a loss of 7 crore versus over 100 crore profit last year. This was a couple of days ago, but brokerages have now downgraded the stock after the conference call.
It's a strong quarter for MAS Financial. 35% net interest income growth drives profits higher. Asset quality remains stable.
Varun Beverages rally continues. Management tells CNBC-TV18 that Q4 is looking promising, also targets double-digit growth going ahead.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangalam Malu. Well, it's actually a good start for our markets. The rest of the globe, well, they were struggling. But we opened up with a gap down of close to around 120, 130 points odd. But that dip has got bought into and the Nifty has moved into the green. So that's good news actually for the bulls. Big recovery is what you're seeing. The Nifty Bank, by the way, is up 230 points odd. And way number of stocks are advancing in comparison to the number of stocks that are declining. But Sachidanand Durtekar joins us to give us his trade on the index. Hi Sachi, morning. Well, if someone told you this morning when you woke up that at around 10:30 a.m. we would be chatting and you would be talking with the Nifty at 18,100. If you're a bull, you would grab it. But the question is, what do you do from here?
Good morning, Nigel. Nigel, in fact, we have already initiated some long positions when it comes to indices. And if you look at the way Nifty recovered from that support of 18,000, it is quite commendable. It has managed to sustain about that 5-day exponential moving average, and the recovery has been robust. But we don't see the expiry for Nifty above 18,200. So probably 18,100, 150 could be an ideal zone when it comes to today's weekly expiry zone. But if you look at Bank Nifty, I think this is one particular area wherein the short covering could be much more robust. We are expecting the expiry for Bank Nifty somewhere close to 41,600 or 47,700 within this particular range. So if you look at the opportunity from a trading perspective, I think it is better to build fresh longs even right now in Bank Nifty. The stop loss should be placed at 41,160, and on the higher side, we are expecting a swing towards 41,700.
Take that point. 41,700 is what you're looking at. In terms of individual stocks, what are your ideas today?
Good morning, Mangalam. Mangalam, I think Reliance Industries, the setup is really good. For the last 4 trading sessions, it has consolidated well. It has been maintaining its tail above its 5-day exponential moving average, which is placed at around 2540. If you look at the daily chart, we are seeing a bullish pennant formation at a mature stage. We have the ADX on the daily scale, which has broken out about 25, which is a good sign of momentum. So we see this particular stock moving towards 2600, 2610 in a day or so. Long positions are advised here. Stop loss should be placed at 2528. The second stock on our radar has been Concor. The stock is quoting at its live high. For the last 3 trading sessions, it consolidated well, but it was not sustaining above the 800 mark. Today, we are seeing a fresh breakout. The call writing activity had been robust in the last 3 trading sessions at around 800 mark. So we see that there could be a short squeeze which could take this particular momentum higher. So we are expecting a price target of around 835 on Concor. Fresh longs can be added here with a stop loss of 795.
All right, we take that point. With that, let's shift focus to a special segment where we get you a few ideas of profit coming in from our colleagues at Money Control Pro. Nandish Shah joins in with a stock that he's been tracking.
Hi, today's ideas for profit is Chennai-based Nelcast Limited. Nelcast is into manufacturing of ductile and grey iron castings with a manufacturing capacity of 1.6 lakh tons, and the plant is in close proximity to major manufacturing hub for automotive companies. We are currently witnessing a favorable CV cycle with domestic, medium and heavy commercial vehicle sales expected to grow at a CAGR of 20 to 22% between 2020 to 25. The company plans to get into higher value-added castings for the export market, which will improve margins. It is currently launching 4 products for pickup and delivery trucks in the light vehicle segment in North America, as well as increasing the share of the business in the existing parts. Apart from the existing capacity in the 3 plants, Nelcast can increase the capacity by a further 50,000 metric tons through a brownfield route at a capex of 60 to 70 crores. On the back of higher volumes in exports, supply of value-added castings, and operating leverage, EBITDA per ton is likely to improve to 10,500 and 12,500 in FY23 and FY24 respectively, as compared to 7,900 per ton in FY22. Nelcast has invested 40 crores in a wholly owned subsidiary, which has 400 acres of land parcel. In the next 2 to 3 years, the management plans to divest, and the proceeds will be utilized for the repayment of long-term borrowings and working capital requirements. As per our projections, it is trading at 10 times FY24 earnings. Investors with a long-term view can accumulate and add on declines.
Welcome back. Let's get chatting with the management of Triveni Turbine. Saw revenue growth of over 40% in the second quarter, while margins remain flat. Order inflows too were higher at around 360 odd crores, which is a growth of 18% compared to the comparable quarter last year. Nikhil Sawhney, who's the Vice Chairman and Managing Director of the company, joins us to tell us more. Nikhil, first things first, your order booking in the first half has been close to around 719 odd crores. What I want to understand is what kind of order inflow are you expecting in the second half of this year? Can you break that up in terms of domestic as well as exports, and what does it mean for your execution this year?
Well, firstly, very good morning, Mangalam, and it's great to be with you. Triveni Turbine has had a record turnover in this quarter, record EBITDA in this quarter, and record order booking in this quarter. As I think I've spoken to your colleagues several weeks ago, we'd advised our investors that to look forward to a 35% odd CAGR growth for this year and next year. And that's a performance that we are targeting. And so that, to give you an idea in terms of H2 of this year, we anticipate it to be better than H1 on all matters. And coming into FY24 as well, because we're a capital goods company where we work on an order book, we are very optimistic on the growth that we will be able to display next year as well. And this combines both our domestic and international markets. We've seen the international markets grow far more rapidly for us as the world has opened up considerably more over the course of the past 6-8 months. And we see that continuing. The primary areas of investment are into thermal renewable solutions, in which Triveni Turbine has a global leadership position. And so we see this continuing. Given the fact that there is an increased amount of investment going into the sector, but we as our company ourselves have diversified and expanded our market opportunities by adding new product lines. And this is what gives us confidence to sustain growth in the coming quarters and years.
Hi, Nikhil. Morning. This is Nigel on this side. So you're sounding reasonably optimistic. 35% growth, if I heard that correctly, for the next 2 years, right?
Yeah, that's what we've advised our investors.
So then, last year you did around 850 crores or thereabouts of revenues. By FY24, you'll be doing in excess of around 1,500 crores?
Most definitely.
Okay, all right. So we got you on that. What about on margins? What should be the guidance on that front? And also, out of this total 1,500 crores, how does it split up between domestic as well as exports?
From an execution perspective, we would assume that by that point in time, we would be slightly shy of 50% export. The reason is that we would be coming in with a higher order book from the domestic market. But though we see the export market as being a greater driver of growth, because while the Indian economy is very robust and it still has many sectors still have to add fixed capital formation into their investment pipeline. We think that the export market will offer more opportunities for us in the medium term.
And margins?
Margins is as a company which has a good market share in India, a dominant market share in India, and we are in one of the leading companies globally. We actually don't face too much price pressure. So for us, where we have a capital equipment which stays with the user for 25, 30 years, we need to be cognizant of their return metrics as well. So we have advised our clients, our investors, that we would ensure that a PBT margin remains above 20%. And that is what we'd like to go with and push for further growth. And I think the growth is really what we are going to be pushing for to ensure that we don't dilute margins. So we have a lot of positives which will come along the way. One is that we'll have operating leverage with a higher turnover. Secondly, with a higher export as a percentage of sales, we would have better margins because exports do have better margins. then also aftermarket as a percentage of turnover will also rise, giving greater confidence to stability in margins. So we don't have margins as a problem really, and they will fluctuate around this 20% odd level. If your EBITDA margin that you've taken on your screen right now is, of course, without any additional income, which is of our treasury income, which, as you would have seen, we have announced a buyback in this current quarter because the company is a high return company on both return on capital employed as well as return on equity.
Nikhil?
Approximately.
Right.
Yes.
Nikhil, just to confirm, margins will be around 20%, right? That's what, because of the levers that you mentioned, aftermarket, exports, operating leverage. So 20% is the ballpark number you're looking at. EBITDA margins.
Yes.
All right.
Yes.
Got it.
Well, EBITDA will be higher. We talked about PBT.
And EBITDA would be how much?
Well, your calculation is without other income, so I was including other income in that calculation. Because actually, our reported PBT numbers, EBITDA margins are in the region of about 22% right now.
So
compared to that, how much are you looking at?
About the same.
Okay. Maintaining margins.
Take that point. You've also announced a buyback. It's roughly 23% of your equity, which means that it will perhaps require shareholders' approval as well, and not just the board approval. Just wanted to understand if promoters are going to participate in this.
Yes, I think this is something that we've been asked for by a lot of our, especially large domestic mutual funds. We think that this is a good way to return a bulk of money back to shareholders. Promoters do plan on participating as well. And we look at this as a manner and means by which all shareholders should participate and get the returns back. We think that our previous attempts of doing a buyback have been met with equal success from the shareholders. We had great participations at all levels. And so we look forward to good participation on this buyback as well.
Right.
Ultimately, the company is sitting on a good cash pile, and we are confident of increasing our cash generation going forward. Our free cash generation on an annual basis without returns to shareholders is about the same as our profit.
Right.
So therefore, we're quite confident in terms of growing our cash pile in the years to come.
Take that point, and that would provide a good signal to shareholders, etc. as well. But you said that the share of aftermarket would increase in your overall revenue going forward, and that would aid your margins as well. How much does that stand at right now, and what is your intended target for it?
Well, last year in FY22, the percentage was 27% of turnover. In this current quarter, as you would imagine, quarter to quarter, there are changes that happen. It was at 23%. But for the full year, we would imagine it to be somewhere in the region between 27 to 28%. And this would rise by about 1% a year because we are also growing our product sales. And so that is growing quite rapidly, as you can see from our order booking.
And what is the rough margin differential between aftermarket and the other orders that you get?
It's quite considerable. In India, of course, the fact is that our customers demand us to not charge excessively on the aftermarket. But as you would understand from most capital equipment, the aftermarket is what really does sustain the profitability of the business. We are very fortunate of being one of the few rotating equipment companies to earn a good margin on the product as well. So on a combined basis, you have the results. But in general, the domestic margins for product are somewhere in the region of between 8 to 10%, and on the export market, it would be double that. And in the aftermarket, it would be somewhere in the region of about 25 to 30% on an average basis.
Okay, all right. And Nikhil, very quickly, I think you spoke about market share as well briefly.
Yes.
What is your market share? Can you put a number to that?
Our market share in the Indian market is about 50%, with the other half being represented by Siemens. So our principal competition is with Siemens, both in India as well as internationally. Of course, Siemens is a much larger company globally, and they are our benchmark in terms of competition. So we do regard them very highly. They're an extremely competitive company, and we aim to benchmark both our performance, cost, delivery, and customer satisfaction with them.
Right. And finally, before we let you go, recently, earlier we had that deal where Triveni Engineering did exercise its rights as a promoter. You, at that point, had said that you expect further inter-sea deals to perhaps clarify or simplify the structure. As of now, Triveni Engineering doesn't hold any stake in Triveni Turbine, but do you guys hold any stake in group companies which may have to be sold going forward? I mean, is there any other thing that we can expect going forward?
Mangalam, I don't think that there's anything in the public market as of now. These are things that take a period of time. I think that over the course of the next year or two, the succession planning would be in place. To the extent that they would impact markets, it will always be positive. We would always be transparent, give enough notice. But I don't see any capital market-based activity actually happening. If so, there will be interstate transfers, and so largely they would be from a market perspective.
Okay, all right, Nikhil.
But having said that, we were very pleased with the participation that we got in the
Right.
sale of shares that Triveni Engineering led. The 1,600 odd crore
Yes.
deal size, where 840 crores was taken up by very large, very reputable mutual funds and
Yes.
foreign institutional investors, including sovereign wealth funds.
Absolutely,
and,
Nikhil. Absolutely, Nikhil. We appreciate you joining in, and we take note of those funds as well that have come in. And now they're going to be tracking this guidance that you've given. So we appreciate you stopping by, giving us that guidance. We'll hold you to that, and looking forward to chatting up with you rather soon. Thanks so much for joining in. For the time being, though, we'll slip into a short break. We'll come back and we'll get chatting with the management with Securities Solutions Company, SIS Limited. You stay with us. Welcome back. Well, as promised, let's get chatting with the management of SIS Limited. They reported their fifth straight quarter of declining margins. However, the revenues grew by close to 13% in the quarter gone by. We have Mr. Dheeraj Singh, the Group CEO of SIS, who joins in. Hi, Mr. Singh. Good morning, and thanks so much for joining in. Let's get straight to the margins. You have said that the decline is likely to get arrested, and it was a temporary phenomena. Do you believe the worst of margins are behind now, and we'll see an improvement from here? If yes, to what level? Go ahead.
Absolutely. We believe that the worst is behind us. If you look at this current quarter, we've grown the top line in security by 8% and in facility management by almost 9.5–10%. If you look at the margin trends also over the past 3 quarters, SIS standalone has grown from 3.8% EBITDA margin to 4.1% and then to 4.6%. So we already are the 4.6 and we are inching very closely towards the pre-COVID levels in the subsequent quarters.
4.6 is including other income, is that what you're saying?
SIS standalone income.
Yeah, all right. And if we just take a look at the international security margins, that have come off from what, 4.9% to around 3.3%. There has been a fair amount of minimum wage hike in Australia, etc. I just wanted to understand, what is a steady state run rate that we can expect for the international business margins?
So international business, there are 2 phenomena that have happened. One is it has seen an unprecedented minimum wage increase of 4.5%. And there's a lagged effect of that. We have to increase the cost, but the contracts and the pricing to the clients will happen in the subsequent next 2 quarters. So we hope the margins to catch up at that time. Okay. Secondly, there were a lot of pre-COVID COVID special contracts which had superlative margins. That obviously came out. But in spite of that, in this quarter, the international business has grown by 3.5% if you take the COVID contracts out. And there's been $25 million of new wins in this quarter itself.
You know, Mr. Singh, you said that the standalone business, that's the India business, there's been a good recovery in margins. We take that, 4.5% odd. But, you know, earlier it was at 6.5%. So when do we get back to those levels? And also on your international security business, the revenues are stagnated. You know, 1,200 crores, 1,150 to 1,200 crores. Should we go with this run rate, or will there be an increase from here on? On both those 2 points, please answer us.
Yeah, so in India business, if you look at the margin for security, which is our main pillar, that has grown by 22% quarter on quarter, the absolute EBITDA. Similarly, the facility management is grown by about 8% absolute EBITDA. If you count the cash business also, that's grown by almost 25% on a quarter basis, right? So the India businesses are seeing a strong rebound on the EBITDA level, and we expect this trend to continue very strongly over the next few quarters.
When does it get back to 6.5%, sir?
I won't promise a date, but Q4 will see it coming very close to the pre-COVID levels.
All right. Q4 is when you look at pre-COVID levels of anywhere between 6.5 odd percent. That's on the India securities business. We take that point. But, you know, while margins have reduced, what's gone up is the working capital. I mean, how much has your working capital days increased by? How much have they increased by? And will they go up from here further?
Well, if you see in the past quarter, the growth has been phenomenal. And with that, there's been some pressure on the outstandings. But we don't see it increasing further from here. Most businesses are stabilizing. In fact, there'll be a reduction in the subsequent quarters.
So what does your working capital days stand at right now? And how much do we expect them to reduce by?
So for different businesses, there are different levels. But on an average, we are targeting about 70 days. for the group.
Right. And as far as the facility management business is concerned, the third quarter is seasonally strong for them. I mean, what's the kind of order run rate that you're looking at out here? And does it go beyond this 471 crore revenue every quarter? What is that business likely to grow to?
Absolutely. If you look at the September run rate, so on a quarter basis, now we have crossed the 500 crores mark, right? So for per quarter now, we should be run rating at a 500 crore, which is probably the highest ever by any Indian FM company in pure facility management services. And the Q3 and Q4 is got a very strong pipeline for facility management business. So that should only build on that.
Okay, all right, Mr. Singh. Well, we appreciate you stopping by and giving us those guidance. You're sounding optimistic. For me, the takeaway was worst of margins are behind and you'll see it improve from here on. Keep things safe and thanks so much for joining in and giving us all of those details. Well, we've completely run out of time on Chartbusters, but you stay with us. Trading Hour comes up next.